What's up, guys? Welcome back to another episode of Behind the Facade. On today's show, I am speaking with Jake Clopton of Clopton Capital, which is a nationwide commercial real estate financing business based out of Chicago in the US. Now, it doesn't matter really where in the world you are based, real estate investment or property investment, whatever you call it, it is all very, very closely aligned with the banking and financing sector. One does not really work without the other, or certainly they would definitely struggle without one or the other. And what you might find interesting about today's conversation is the fact that Jake had absolutely no knowledge or experience of real estate investment, of the sector in any shape or form, and really just spotted an opportunity in the wake of the 2008 global financial crisis. So it really just proves the point that every crisis can be turned into an opportunity, and it's really down to your mindset and how you look at that particular crisis. So without further ado, let me get into my conversation with Jake Clopton. You are listening to Behind the Facade, the number one podcast for investing with a particular focus on the real estate and property investment market. I am your host, Gavin J. Gallagher, and on this podcast, I'm going to be exploring the mental and emotional game often playing out subconsciously, both in your mind and the mind of everyone else in the real estate market. The key to success in this game is to master your mindset and behavior, to take control of your thoughts, your emotions, and most importantly, your ego. Welcome to the show. Jake Clopton, welcome to the podcast.
Thanks so much, Gavin. Appreciate having me on.
Not at all, Jake. Tell me this now. So, as I mentioned, this podcast is quite an international sort of audience. Can you just tell us where exactly in the world you are as we're having this conversation?
I'm sitting in Chicago, Illinois.
Illinois, the Windy City, yeah.
There you go.
Good stuff. And I would have already introduced you and some of the stuff you have done at the beginning of the podcast. But just for a little bit of context, I always like to ask our guests, can you just kind of describe what a young Jake Clopton was up to, and if there was any kind of influences that kind of got you into the career and kicked off your career for you?
Yeah. So, I mean, I grew up in upstate New York. I went to like a Jesuit high school, went to a Jesuit college. I studied economics in school. And then after school, I had a little bit of a different type of path. I actually didn't go right and get a job, actually moved to Argentina for a year and kind of stayed there. I was always kind of into stocks and stuff. And I was like trading stocks and stuff while I was living down there, just kind of for myself. When I was done there, I mean, at a certain point, I was like, all right, I gotta figure something out, right? So I actually moved to the US, and then I did accounting for a resort in Florida for a year, and then moved to Chicago and traded futures. And then 2009-ish era, started my company now.
Okay. And so you, in terms of the 2008 crisis that took place, did that have a dramatic impact on your, what you were doing at the time?
Well, I was trading interest rates, and interest rates went to zero, and I really needed like volatility to make money, right? To make trades. So yeah, it was a big impact, right? I really had to I was like, well, this is over, basically. So I had to figure out something else to do. And I was looking around, and there was always this concept that there's going to be all this commercial debt that was going to be coming due, and also that like finding business capital and finding loans was really difficult. So that was my idea, right? Somehow to insert myself, like I didn't have $100 million to lend out, right? So I had to find some way to insert myself kind of into the transaction and make the transaction cost. That was my general idea. Basically just to be an intermediary, right? Between people that are looking for capital and people that had it to lend out. So.
And that's actually, it's a good thing, because everybody that I speak to that is kind of looking for advice, almost always they're wondering, how can I find investors? And rather than going out and trying to meet the investor, it's a lot easier to meet an intermediary who knows the investor and can kind of get in front of them that way.
Right. And as an intermediary, right, if you go direct to investors, that's one investor, right? But an intermediary is really like a leveraged position that may have 100 different investors, right? So you get to leverage your access that way.
Yeah. It makes a lot of sense. And I mean, was it on the cards always for you to start your own business?
I don't like wearing ties. So, yeah, I was always kind of driven in that direction. And I think it's just for my personality, it's just a much better fit. So.
Right. Okay. Yeah. And so, I mean, prior to, there must have been a bit of a transition for you to go from trading, interest rates and things like that to running your own business. Like, what was the first, what was the big challenges that you had to overcome in that initial step?
Well, when I traded, I actually worked from 1 a.m. to 4 p.m. every day, which
Oh,
is
wow.
really a long day, right?
That is a lot.
And so yeah, as far as like work hours, putting that in, like no, I was probably actually, working less, working for myself. So like the whole work ethic aspect was like, already kind of there. The biggest difference for me was actually talking directly to people versus just like trading on a screen, right? I
Yeah.
mean, when you're trading, it's just you and a computer, and that's pretty much it. But then, when you go to be an entrepreneur, it's I really had to develop the whole like networking aspect of it, just making phone calls, making relationships, stuff like that.
Those soft skills of building a rapport and stuff like that.
Right, exactly.
And was that difficult, that transition?
Um, not really. I mean, I think it really just comes down to like desire and motivation to start doing it. And I really just started making phone calls. I mean, I think even people that have sort of like anxiety to make phone calls, like once you just start doing it and you've done something 100 times, that kind of burns off, right? And then you
Right.
you really get a lot more comfortable with it.
I get you. Okay. And I mean, they say entrepreneurship's like pushing an aircraft off a cliff and then learning to fly on, on the way down. I mean, is that what it was like in those initial kind of, you've given up trading, so your income has stopped there, and you obviously have to kind of figure out how you're going to generate something on the other side. I mean, what was that period of time like?
Right. I mean, you hear stories about these people that start businesses and it's just like a meteoric rise, right? But I just don't really think it happens like that. I think what you hear about that when it's happening, but what you don't see is the whole build up to that, right? I mean, realistically, when I started this business, it was a long ride. I mean, it was several years before I really figured it out, really started making money. So I just think you need that concept of grit and sticking with it.
Yeah.
And it's usually right about when you feel like you're a failure that if you push through, it starts working. You know what I
Yeah.
mean? So it was really, it's a whole learning curve and like being able to accept like you fail at something or it doesn't work, you learn from it, you move on. Say, okay, well, I'm not going to do that again, right? And you kind of pivot into another direction and keep going until you've like figured out the correct path and how to do things.
That's interesting. Yeah, actually, it's good point there, because there's a thing called survivorship bias. And it's that whole thing where you hear these stories of people who had the meteoric rise. The reason you hear those stories is because they survived long enough to be able to tell these great stories.
Right.
Whereas the
Right.
100 other guys or the 99 other guys that kind of flamed out and didn't go anywhere, they're not out there sharing their story and stuff. So you'll only
Right.
ever hear the
Right.
good
Exactly.
stories.
It's a self-fulfilling prophecy, right? You think everybody that starts their own business is all of a sudden going to be a billionaire or something like that. But you don't hear about the other guys in the business that failed, or like the guy that took 10 years and just kind of had a slow ramp up and grind it out. Right.
Yeah, it's so true. And so, I mean, in terms of you going out and starting this, I mean, did you have a kind of unique selling proposition for your clients? Or, I mean, how did you go about sort of the pivot from doing stuff in front of a computer screen to suddenly kind of calling people up and
Well,
asking?
yeah. I mean, I was kind of in a unique position, right? Because at the time, it was a financial crisis. And when there's a crisis, there's opportunity, right? And just like the big gap was people couldn't find money. So really at the time, if you were telling people like, hey, I can get loans, I have, and I have access to capital, people just kind of came to you. You know what I mean? So
Right.
I think it was, the right time and the right opportunity to be able to do that. I mean, you can still there's no reason why you can't get into this business now. But it was one of those periods of time where it was just a huge opportunity to kind of insert yourself and maybe move a little bit faster than you would have, and there's less competition and all these types of things.
And during that crisis, I mean, I know because I went through it, and I had a pretty torrid time. I was kind of pretty long on real estate, and so I actually had quite a lot of debt. And so I spent most of my time firefighting during that period. Were there many people that had like a lot of cash sitting around, like ready to invest in the deals that you were bringing them?
Um, so at the time, there was kind of like a liquidity squeeze. right? I mean, and that's really where it came from. Is people had a lot of debt, a lot of assets, but for the most part, I think a lot of people were very unprepared for the financial crisis.
Yeah.
In what happened just recently, right in 2020, the general theme was there's lots of liquidity out there to really go and pick up deals and chase deals right away, right? I mean, because everybody kind of learned from back in 2009 that when a crisis happens, there's lots of opportunity. So there was like equity funds and there was people waiting in the rafters to kind of try to pick up deals. But yeah, I mean, it was difficult to do deals back then, right? I mean, lenders, were, and the biggest problem and the biggest, back then, the biggest difference between 2009 and 2020 was that lenders were not capitalized, right? So the lenders really, their balance sheets were stuck and they had difficulty lending out money. Whereas in 2020, it was not a lender issue, right? The capital markets, the lenders were, were healthy. The lenders were well capitalized. So, that's why, I think the hangover from 2009 lasted so much longer versus 2020.
Yeah, it's interesting. And obviously now that stimulus and all of that liquidity that was kind of thrown into the market, it has had an impact on inflation. And we're obviously reading and hearing a lot about inflation fears and all that. How are you seeing, I mean, given your past in trading interest rates and stuff, and the volatility you used to look for, I mean, I guess there's a fair bit of that out there now. Is it starting to change, do you think?
Yeah, I mean, look, so if you look at like the expansion of money supply, right? I mean, we expanded M2 money supply in about a 2-month period, the same amount that back in 2009, I think took 5 years.
Wow.
So the money supply expansion was just astronomical. And and that really filtered quickly kind of into the system. But what they did differently this time too was direct payments to consumers and stuff like that. So it was really from the top and the bottom, right? I mean, there was just so much cash coming into the system. That's why you saw these crazy things like retail stock traders, going through Robinhood and buying options and GameStop exploding and all this stuff, right? There was just so much liquidity out there, so. Yeah, I mean, generally speaking, and as far as inflation goes, like inflation is good and bad, right? I mean, I think part of the whole idea with inflation today, and maybe not what they're not saying, is that like we're trying to inflate some of the debt away. Yeah. So that like the interest payments, everybody's levered up, right? When they do QE, everybody levers up their lower interest rate debt. And so try to like lessen the burden on some of that debt that gets accumulated through through times when the government's out there buying up all the bonds and all the assets and just inflating asset prices. So generally speaking, I think inflation will be a positive factor. But and there's definitely areas that are better prepared for it. Like real estate in general, kind of is typically a hedge for inflation, especially some sectors of it, right? So I think paying attention and knowing how to position yourself, it is definitely going to be an advantage today.
Yeah. The only concern, I guess, is that if they start to shift the rates upwards, that there'll be people out there that could get just caught out by the fact that the rates moved faster than they expected.
Right. And that kind of goes along with the whole levering up with cheap debt thing, right? Yeah. I mean, and that's what happened in 2009, right? And all these consumers had levered up all these houses with cheap loans, and then it's with these adjustable rate mortgages, and when those rates popped, right? I mean, the debt service crushed them, and it always happens, right? There will be people that are not positioned well, and they'll be paying when you raise interest rates. But I mean, generally speaking, as long as asset prices and incomes are rising with interest rates, the economy, will be fine.
Yeah. Jake, in terms of, you mentioned that it took you a couple of years to figure things out when you started your business. I mean, at what point, was there a particular moment where suddenly maybe you landed a big client or you did a big deal or something happened that made you kind of go, oh, wait, hold on a sec. I figured this out. I think I know how to make this work now. Was there a moment?
In retrospect, there probably was. I think when you're in that moment, it's hard to recognize it.
Yeah.
In my business, the revenue you get is much more choppy, right? So it's like, you work, how it is in real estate. You work on something for a long time, and then it finally closes, and then it happens, right? But it's the whole like the whole work going up to that closing that people don't really see, right?
Yeah.
And I mean, realistically for us, it was just when we, had figured out what we wanted to do, what we wanted to focus on, and then started closing those deals. And that was really probably, 2 years in. When the P&L kind of flipped to being positive versus, just kind of chugging along there, and not really, making a lot of profit. So yeah, I'd probably say that like the 2-year mark when, I was able, when I really recognized that like, hey, I mean, this is something that is working well and not only will, support my life, right, but also generate a large return, in other ways.
Yeah. And did you have like mentors or anyone kind of to help you kind of guide you along in this path?
No, not a
Wow.
single
Okay.
one.
Not a single one. Okay. That's so you've learned the hard way, in other words.
Yes. It was, mistakes were my mentors, right? So go, and that's what I've never been afraid to do. Screw up, right? Go in, screw up as much as you can and learn from it. Right. And it's like, hey, if there's 100 ways to do something, if I screw up 99 times, I'm going to figure out that one way to do it eventually. So.
Yeah, it's a good way to look at it. And tell me, I mean, habits and behaviors are critically important. I mean, is there any particular sort of habit that you've developed that you think has been critical to the success you've enjoyed?
Yeah, I mean, I really think it's the concept of just grit and staying with it. I think a lot of people, like I don't think every single person out there wants to be an entrepreneur, right? And but the people that do, the ones that I kind of see that, it doesn't really go anywhere, or maybe it just doesn't work out for them. It's really just because I wouldn't say it's intelligence, right? I mean, I don't think owning and operating your own business is rocket science, right? It's really about just staying with it and then being willing to make the mistakes and learn from mistakes, because like I said, I feel like 90% of people probably bow out right before they're about to start, doing well, right? Because I mean, that what typically happens right before then is, you're making the most mistakes, and eventually, the curve kind of goes upward for you from there because you've learned the right things to do. So, I mean, I think it's grit, sticking with it. And, and I'd say the other side of that is, obviously you got to live, right? So properly managing your monetary risk, right? Like, if you're going to start your own business, probably don't hold all of your savings in Bitcoins. You know what I mean? This is risk on risk. So, yeah.
That's an interesting one. Yeah. Well, it's funny you say that. I just was speaking about Bitcoin on this morning's podcast. My podcast goes out every Monday. And I was talking about the differences between the stock market, crypto market, and real estate. And I'm curious what your view is on those three. I spent an hour talking about it yesterday. So I'm just curious. I mean, what is your perspective on those three?
Good question. Okay. So I like real estate, right? I mean, I can go there, I can knock on the walls. It's physical, it's a real asset. It's what I know, you know what I mean? And like, it's all I do all day long. So I like to invest in things that I know, right? I mean, I don't want to run every race at the track meet. I want to do one of them really well and stick with that. I'm the world's worst stock picker. So I'm just going to completely stay away from that. You know what I mean? Like I have like a guy that does that for me. You know what I mean? I've just learned to stay out of there, man. It's not my, it's not for me. I mean, as far as cryptocurrencies and Bitcoins, I've been learning about them and reading about them, and for years now, since 2 years, whatever, I don't understand a practical reason for them. I mean, I don't understand why they need to change price. It doesn't really make like, I understand, you need this like value to convince people to do mining, but I understand why it actually has to change price. And then also, I put this on LinkedIn. I have a big 30,000 people LinkedIn following. And I put this out there several times, like, hey, can somebody tell me, have you ever bought something in Bitcoin or Dogecoin or whatever? I don't care. What was it and why did you buy it, right? And I've yet to have a single person. It's always like, oh, I knew a guy that knew a guy that bought something. I've never had a single person actually say like they bought something. And then the last thing I'll say about that is, I've looked into kind of like, okay, well, there's all this, you hear about all this transaction volume that's happening in cryptocurrencies. Like, it's $20 billion worth transactions a day. But there's, I believe it's called like blockanalysis.com or something. You can go in there and you can see that only 1% of all transactions was actually a purchase. Everything else was just a trade. So
Yeah.
I don't know, man. I think blockchain is just a more secure way of doing things, but I don't know about the whole cryptocurrency thing. So
Well,
I also think governments have, really want to control their money supply. So I think that's coming eventually. So
I think you're absolutely right. By the way, I actually got told about Bitcoin. I have a friend who was into all of this kind of stuff way back, and so back in 2012 or 2013 or something, I found out about Bitcoin, and he suggested that I should go and buy some, and it was $93 per Bitcoin.
oh,
The annoying thing is I didn't do anything because a couple of days later, when I started trying to buy it, it had jumped to 140, and I kind of thought, whoa, it's like, gone up 50%. That's not the time to buy just after it's popped 50%. So I kind of just decided not to, and of course it went off on its train. But the thing is like, you can kind of look back and say, God, why didn't I do it? But the reality is as soon as that thing popped 200% or something like that, you probably would have exited thinking that you're a genius. And here we are now. Like, who holds on to something until it goes up, 12,000% or whatever? Like, most people would exit long before it ever achieved that kind of a return.
right. And it does seem a little bit like a game of musical chairs, right? I mean, it seems like it exists to exist. You
Yeah.
really, you know what I mean? And like, I mean, it's really like a trading, type of thing. It feels like, and then, that's why, when it drops, I feel like there's just huge volatility because people are like, all right, this is it. This is the Bitcoin winner. I'm out, So
Yeah.
I don't know. We'll see.
Well,
But
that's the thing that it's funny. The difference between, say, stocks and Bitcoin, like you say, and just that you're the worst stock picker, I feel like I'm in that same boat as well. It's the volatility is the biggest problem, and it's the emotional reaction that you have to that volatility. So if you go and put an investment into those things, and then it drops 50% overnight, you feel like, oh my God, I've made this terrible, error, and I should sell, and I should never have gotten into the damn thing. Whereas with real estate, it's this nice and steady. Now, obviously, 2008 aside, because I watched my portfolio fall by 60%, but most of the time it's much, much slower. You're not talking about every couple of hours these huge fluctuations and swings.
yeah, you don't get a mark to market every second,
Yeah,
right?
exactly.
And in real estate, and I feel like some people don't feel this way. I mean, real estate, no matter what you own, it's a business, right? You can go in, you can make changes, you can do things, you can market it more, and there's something you can do about it. Versus, like, the other things we're talking about, stocks, Bitcoin, also, that's not really a business unless you're actively trading it every second or something. Then sure, yeah. Like what I used to do when I traded futures. I mean, I was in those trades for maybe, I don't know, I would say on average less than a minute. You know what I mean?
Wow.
And
Yeah.
so, like, and people even ask me now about, like, oh, well, where interest rates going? I don't know. I can tell you where they go in the next 30 seconds. But like,
Yeah.
they're going to be higher or lower than they are now. You know what I mean? So the long term predictability of stuff like that is difficult. But,
Yeah. And do you suffer from FOMO, the fear of missing out, or have you capped that?
I have no fear of missing out now. And like I said, like, and that's why I've just learned to stick with what I'm doing now, because I have friends that, like, are, oh man, you should buy some Dogecoin and this and that. Like, no, you don't
Yeah.
want me to. It's gonna get cut in half as soon as I buy it anyway. So.
Yeah. Tell me this about the clients that you've managed to attract over the years. Do any, I mean, we all have, either clients or people that we work with that are doing something right, that they're particularly successful at what they do or whatever. Is there any that's sort of traits of those type of clients that you have that kind of stand out as what it is that they do right that has kind of led to their success?
Um, yeah. I mean, the clients that I have, operate real estate as a business, right? And a lot of the guys that, we deal with are, syndicators and equity raisers, right? And I think the guys, and I'll just talk about, the whole equity raising thing specifically. I think the guys that, are successful in raising, investor equity from individuals and stuff like that, have really learned that real estate is a networking business as much as it is an asset management business, right? And really, focusing on, building good relationships and how to network that investor base. the guys that, I've seen that eventually end up, expanding really well, right? Have really got that concept down. There's other syndicators we deal with that kind of like, it kind of seems like you have a small little group of people and they just keep going back to them. And they're like, well, my investors are tapped out, so we can't go buy more asset, and it doesn't seem to be a big push to continuously network and market themselves as a brand versus just kind of dealing with the same guys over and over.
Mhm.
So as far as like the guys that I've seen that have expanded, right, like AUM, like substantially that I've watched over the years and dealt with, I mean, the whole, concept of, real estate as a relationship and a networking business as much as just manage the assets. I mean, that's probably one of the key points that I've seen those guys been able to do.
Manage the assets and crunch the debt. That's what they
Right.
say. Yeah.
Yeah.
And is there any, I mean, obviously COVID had a big impact on certain sectors of the real estate market. I mean, certainly the office sector here that I look after. And, but in particular, I'm thinking about hospitality and stuff. Do you have any clients that were in that sector that have had to kind of pivot dramatically?
Yes. So actually, we do a lot of hospitality.
Right.
COVID was interesting because the way that it impacted, every asset was actually kind of a little different, right? I mean, it depended on where you were and what it was and what kind of demand generators had for the asset, right? So, for instance, and this is not what you would have thought, right? Depending on his assets. That I had a client that owned a hotel, near Times Square in New York City. That thing lost all its revenue, right? And there's no way around it. They shut everything down. There was no travel. There's nothing, right? So that lost almost everything. And I also have clients that had like, hotels that were near the beach in Florida. Those guys saw record revenues, right?
Of course.
So a lot of the impact on different assets varied very much so depending on like what the local government was doing, what type of restrictions they had in place, right? I remember going down to Florida during kind of like, I think it was like August 2020. It didn't exist, right? I mean, nobody had ever heard of COVID out there. But I come back to Chicago, it's like, oh my God, I gotta get my face mask on and do all this stuff, right? And people were doing different things, right? There, as far as like, the demand generator of business travel, I mean, that was gone. I mean, it's still, not close to where it was before. But leisure travel and destination places, I mean, those are still seeing, very high, like higher than 2019 revenues, right? So, a lot of it was just what was your business makeup, as far as demand generators and where's it located? Like what kind of restrictions are set in place? I mean, for instance, it's still like that today, right? Like if you looked at the difference between, let's say, a bar that's in downtown Chicago in Cook County, if you walk into that place, you have to show your vaccine card or they don't let you in.
Yeah.
Right. But if you go outside of Cook County, where I am, nobody cares. That doesn't exist. So, I mean, still the local government rules, I think, are a major like driving force in how well these, the hospitality businesses are doing and where it's located.
Yeah.
And then like what type of people were going there, like business versus leisure.
Yeah, it's interesting. I had a conversation not so long ago with a chap who has a serviced accommodation business. So he did a lot of the Airbnb type thing where you'd rent it out on a daily basis, or kind of you'd get a couple of days a week of people coming in and using it. And obviously COVID massively impacted his business. And
Sure.
a lot of people in that same sector started selling their assets and all this. And what he actually did is he pivoted, instead of looking for the leisure sort of visitor and the business visitor that he had previously been serving, he started working with the National Health Service and things like that. And there was doctors and nurses and all these people that, because of their exposure to the virus, they couldn't go home to their own homes where their families were. They had to isolate. And so he actually ended up pivoting into this and growing his business by about 400% during the COVID lockdown. So it's very interesting how just a different mindset can actually really serve you.
Right. And that's a great example of real estate being a business, right, versus just an asset. I mean,
Yeah.
you can do something about it. You can pivot the right thing. And we did some similar stuff, right? I mean, in 2020, and what I like to do is, in my business is follow like what's going on in the macro trends, right? And kind of like lean into those. And what was, really big in 2020, and what was expanding was home builder, type of deals, home building projects, home builder financing. So we really hadn't done like maybe more than one or two of these in the past, but that's what was working, right? So we pivoted heavily into home builder financing, and we're able to do a bunch of those deals. So 2020 actually ended up being a pretty good year. Versus if we had just been trying to do, acquisitions or fixed rate mortgages or stuff like that, right? I mean, it would have been pretty tough. So.
Yeah. I guess that's what it's all about. It's really about spotting the opportunities and just moving swiftly and being kind of nimble on your feet.
Right. Absolutely. Yeah. I mean, I think it's the guys that, I mean, not everybody has the ability to do that, right? But it's people that kind of stick with the same thing, no matter what's going on around them, and just put those blinders on. It's like, all right, well, this is what I do, and I'm never going to change this. That's not going to work forever, right?
Yeah.
I mean, you've got to be paying attention to what's going on around you to be able to pivot.
Yeah. And you mentioned macro trends and stuff. That's an area that I'm always interested in. And one of the areas that I'm seeing an awful lot of investor attention these days is ESG and this whole thing around the green and environmental standards and energy protect, for the buildings. Is this something that you're seeing? Is this sort of creeping into more and more of the conversations you're having?
For the most part, the environmental stuff that I see, manifests itself in, let's say, like financing programs or, like incentives, stuff like that. For instance, there's, you get like a little bit more SBA debt around here if you do a green SBA, right?
Yeah.
You have some sort of green aspect to it. There's also something in the US called PACE, which finances a whole lot of like, energy efficiency stuff for buildings, and the stuff that I see personally around the country kind of always revolves around some sort of like, government backed or government funded incentive. And I feel like that's the easiest way that it makes itself into real estate. As I told you, I own a couple buildings, right?
Yes.
And, the way that I've been able to take advantage of, energy efficiencies and let's say the utility efficiency, stuff like that is, one of the buildings I bought was pretty old, and here's a good example. They had these they were like Sloan valve toilets in them, where it was like a prison toilet. Like each flush was like 5 gallons, right? And the water bills were astronomical. So I was actually able to find some incentive programs through the utilities and like the local government that they went in and replaced them all for free.
Wow.
Right. And cut our water bill into like a third of what it was. There's also energy incentive programs, around here. I'm sure there are other places as well. There always are, right? Where they went in and they replaced our boilers and put in insulation and all this stuff. And it really was at almost no cost to us. So that, I mean, I think that, if there is some sort of like energy inefficiency, in real estate assets, and people are looking to lower the utilities as well, from my experience, what I learned, there's almost always some sort of local government incentive or cost saving program to be able to do that.
Yeah.
And it's just an unlimited upside for you, right?
Versus that's it. I mean, what's really interesting is they brought in here in Ireland, where I am, they brought in this LED lighting, and it was, I'm talking about maybe 15 years ago, they sort of said that all new bulbs that were being put into your lights needed to be LED. And these were very expensive bulbs, though, and a lot of people were, whoa, I don't have to pay, so much for all of this. But what was really interesting is I went through this exercise. There was people coming and knocking on the door and sort of saying, we'll put in all of these bulbs at our expense, and we will share the savings with you over, say, a 5-year amortization period. And I was kind of like, yeah, and this was what they offered. And like 3 or 4 different companies came to me with the same type of offer. And I remember thinking to myself, if everyone is doing this, then I'm sure there's something to it. So I decided to go and actually explore, the actual technical, what is the cost of each bulb? What's the cost of this? What's the cost of that? And I went and I actually did this myself. And I put in, and I think the total cost maybe was, 25,000 or something like that to replace all the bulbs. And the entire investment was repaid within 8 months.
Yeah.
And if I had, gone off and not researched this and said, oh, great, yeah, put in all these free light bulbs, I would have spent 5 years giving these guys half of that saving. And instead, my entire investment was completely funded in 8 months. So it just shows you how these little incentives, sometimes they're an opportunity in themselves.
Oh, absolutely.
Yeah, yeah,
Absolutely. And I mean, as far like if you're buying an old building at this point, I mean, it's just going to be incredibly inefficient,
yeah,
right? Versus like having built something new. So I mean, if anybody's investing anything that's more at this point more than 20 years old, there's a way to figure out how to make it more efficient and save a ton of money, on the expenses. I mean, for instance, you could almost buy one of these old like 100-year-old buildings, go in and do that, and then sell it for probably a decent cap rate arbitrage, right? I mean,
yeah, yeah.
just by saving all the expenses.
Well, nowadays, certainly in this country, if you can go and buy a building that's in a certain condition and just increase its energy rating. Now, here in Ireland, we have a thing called the BER, which is the Building Energy Rating, and it's a certificate that you get, and it gives you, A, B, C, or D as a kind of a rating. And the worst buildings, like a 100-year-old building, would be like a G. And if you can get your building up to like an A level or something like that, that is going to make it an investment grade building. Whereas if it's a C or something like that, there's an awful lot of investors that just won't touch it because certain tenants will no longer rent a building that is a C rating. They'll only look for buildings that are A rating because they've got corporate social responsibility and all of these kind of different policies in their corporate governance. And so this is something that I've noticed quite a lot lately. So that is, like you say, cap rate arbitrage there. You could immediately start looking at that kind of thing.
Oh, that's interesting.
Yeah.
That's right. Yeah, I mean, we don't have that type of we have. I mean, we have the sort of certain ratings for buildings, but like a rating system like that, that would restrict your tenancy base. I haven't seen. I'm sure it's coming, but I haven't seen it happen here yet.
I heard that New York is certainly looking at this, and they were talking about increasing the cost for, I think, maybe carbon emissions or something like that on the buildings, and it's going to have this like huge impact on the cost of the big, energy emitting buildings. The big skyscrapers are going to cost an
Sure.
awful lot, and like billions of cost to the landlords, the big, sort of institutional landlords. Jake, what about, I mean, in terms of the fact that you're in the kind of the financing space and stuff, is there any fintech or sort of prop tech startups or businesses that are kind of real game changers in your space, or that have really kind of helped you with what you do compared to when you started out?
Yeah, I mean, technology, right? And as far as like financing, it is always a great tool, right? Um, but like I do in commercial real estate, you can have a small group of people that does a lot of business. And I mean, and there's always, I think, going to be a relationship aspect to it. And every piece of commercial real estate is different, right? So for instance, in residential, I think Quicken Loans works really well, right? I mean, it's like a box. The houses aren't all that different, right? I
Yeah.
mean, you get a credit score, you get a credit score. It's not that different. It's very boxy, right? And there are certain types of financing in commercial real estate to a degree that kind of fit into that. And like, surprise, surprise, it's mainly like Fannie and Freddie, multifamily loans, which Fannie and Freddie also do all the residential loans, right? So they try to make that as close as possible to that. But as far as like fintech goes, like I have yet to see some sort of platform that is just kind of like a Quicken Loan, right? Where it's just an owner of a building goes into a website, plugs in some stuff, gets a loan.
Yeah.
There's just so much more to it, and there's so many variables in all this stuff that comes along with it, that I think that sort of concept, I'm just not really sure is ever really going to come to fruition. Um,
And there's also
but
the
that's
relationship, there's the relationship with the client as well, that a lot of these lenders and institutions, they
right.
don't want to lose that.
Right. Yeah, exactly right. Right. I mean, it's very much a relationship business. Um, and I've been wondering myself, as I start to see investors and sponsors getting younger and younger, and then like, them maybe being more open to the adaptability of just using something like that. Um, Candidly, I haven't really seen that. They still want somebody working with them. So a lot of the fintech that I've seen be really helpful is kind of like more in like the support category. maybe like underwriting templates, or, certainly, like patching through large data sets, right? So some of the guys that, some have really used it well to their advantage. Some of the sponsors I've seen use, large data sets and as much technology as they can to evaluate trends, and then like help them make the decision of like where to invest in and stuff like that, right? So it's really more of a support and analysis role than really a decision making role, if you know what I mean. Yeah. So I think that's where it's going to have its most value in the commercial real estate space, and that's where it's really, helping and making the biggest input.
Yeah, it's interesting. One of our occupiers here in the business park is it's a big, US multinational, and they're in the technology space, but they did a very, very comprehensive fit out, like a retrofit of their building, and they put in these brand new lights that all have sensors in them and everything, and they can tell if anybody is underneath the light. They can sense the air. They can tell whether there's so much CO2 in the air. All of this, it's incredible technology. And they were saying that they've already saved something like $80,000 a year in maintenance costs just by putting in these. Yeah, because they're able to see that this room is not getting used for 6 hours of the day. Why are the lights on? They should just be powered off all the time. So it's interesting, and so it's kind of like what you're saying. It is the data and the kind of the only problem is there's so much data coming from these sensors, is that I think you need artificial intelligence to actually help you kind of use it and interpret what it means,
Yeah. I mean, again, the support role, right? I mean, and that's where I think it's going to have the biggest impact. And maybe at the end of the day, that acts as, one or two jobs that are in kind of in the administration side of things. But I really think it's going to let less people leverage their time to do more ultimately.
Yeah, that's true. That's what it's all down to. Yeah. You mentioned macro trends. Like, is there any other trends that you're watching that you're particularly kind of excited about or interested in following?
I mean, as far as like the commercial real estate space, I think the biggest, the biggest thing that's going on right now that I think most people aren't used to, and most investors aren't used to today, is really the inflation aspect that you brought up before. All through 2009 to 2000, right, like 22, right? I mean, people weren't dealing with inflation. In fact, they're doing deflation.
Yeah.
Right, for a lot of it. And then we're like really understanding like how inflation is going to affect their assets, independently. Like, do I want to lock up my industrial building on a 10-year lease? I don't know. Maybe I don't, right? Maybe long-term leases are a liability ultimately. Yeah. Because, you're going to get that erosion for 4% inflation. And like one of the most interesting things right now, and I was kind of doing some commentary for an article about this, is how hospitality in an inflationary environment is one of the best places to be. Right? Yeah, because you can change your room rates. Yeah, every second. And I think once people will slowly recognize that over time, and I think there'll be a lot more kind of equity dollars that flows in that space because if we continue inflation, right? Yeah. But like really understanding how that's going to affect you, right? I mean, for instance, do you really want to get into a Walgreens that's in a single tenant, triple net Walgreens investment property that's being sold at a 4 cap that has a 20-year lease on it that has 2% escalations every year? Yeah. Probably not. You're going to lose money eventually, right? Yeah. So, as opposed, I think that's going to change. So.
Yeah, as opposed to having some sort of a tenant like a WeWork or co-working or something like that, where people are paying a desk fee or whatever it is. Obviously a desk fee can be adjusted on a weekly basis in the same way as room rates in a hotel or something.
Sure. Yeah. No, right. Same concept. It's like, I believe from the 2009 to 20 era, long-term leases were a huge asset, but I think they're going to start to maybe push more towards, liability, right? Unless there's some sort of inflation adjustment that's
Yeah. Interesting. Well, we have in the Irish market here, and the UK market would be the same. We have 5 yearly rent reviews, and then obviously you look around, and whatever the most recent rent review of a similar type is what the market kind of ratchets up to. And now it used to be upward only rent reviews, so you could never go down once you went up. But nowadays they have upward and downward. But I think now in this inflationary time, we're not so worried about the downward movements any longer.
Right. I think we'll see more of them, like, tied to like a CPI type of metric or something like that, instead of just 2% escalations every year. It probably is going to make more sense for landlords in this environment.
Yeah. I'm just conscious of the time, Jake. There's a couple of final questions that I'd like to put you, and one of them is that I ask my every guest is, knowing now what you know, if you were to look back on your career and sort of have an opportunity to speak to your younger self in that just before you kind of started in your career, is there any particular advice that you'd give yourself, knowing now what you know?
It's a difficult question, right? Because that path led me to here. I guess I would say maybe figure out exactly what you want to focus on a little faster, right? I think at the time I was, and it was an asset, right? I was extremely open to, lots of different, areas that the business could have gone, right? I mean, like at one point we were financing like semi trucks and stuff like that.
Wow.
But it's hard to say, like if I, focused on the wrong thing, right? Or, this and that. So, I mean, the openness, I think definitely helped, but, probably just, I don't know, relax and stick with it easier. As an entrepreneur, you kind of have that like, mentality that you have to, work your ass off because you're just afraid of everything's going to blow up in your face at all times. So, probably just to relax more and not worry too much. It's gonna work out eventually, right?
Just to reassure yourself, it's going to work out.
Exactly, because nobody else does. You know what I mean? Like when you're first starting out, everybody wants to tell you you're probably not going to make it. But then when you do, everybody, wants you to teach them how you did it. So,
yeah. Jake, your business is a nationwide business. Is that right? Yeah.
That's right. Yeah.
Okay. So how can people find you if they would like to reach out and connect with you?
Our website, cloptoncapital.com, or you can find me on LinkedIn, Jake Clopton. I'm incredibly easy to find.
Okay. I'll put some links in the show notes anyway. But Jake,
great.
it's been really enjoyable conversation, and wish you the best.
Likewise, I appreciate it. Thanks so much.
All right, guys, I hope you enjoyed today's episode. Thank you so much for tuning in to Behind the Facade. If you enjoyed the show or found it useful in any way at all, please take a moment to leave a review over on iTunes, or alternatively, share it out on social media or with a friend who you think the podcast could help. If you have any questions or topics you'd like me to cover in future episodes, please connect with me via my Facebook group, Behind the Facade Community. And the long-time listeners will be aware that I have a YouTube channel called Gavin J. Gallagher, where I have recently begun posting these episodes. These actual podcast episodes are up there to watch, and shorter videos from the construction site that we have at the moment, and various other kind of bits of advice and stuff that I put up there. So go and check it out. If you're not a fan of YouTube, you can stay in touch with the various projects I am working on by joining my tribe over at gavinjgallagher.com. And while you're there, you'll be able to check out the online learning and education stuff that I have on the real estate business, including my mastermind. That's all for now, guys. I'll see you back here next week.